So a few things that I listened is, number one, you got to find out, why are you doing it? Why did you get into home ownership? If you got into it because it's what your friends were doing, everybody was doing, I promise you, the minute that your hot water heater breaks, you're going to say, hell with this, and you're going to want to sell, right? So home ownership, like you said, commitment is not the absence of life. It just says that you've made a commitment. Oftentimes what we see, Randy, is that a lot of times people get into home ownership and they exit so quickly that they actually have negative returns. We call that a short sale, when you owe more money on home than what it's actually could sell for. And that's simply because there wasn't enough time invested in home ownership, right? Because not all markets are like the pandemic, where homes are appreciating year over year exponentially, right? And so the first thing that we have to ask, and we get this a lot from the people that we talk to, is why are you doing it? And oftentimes when we hear people, they'll say, well, you know, it's about generational wealth. It's about my legacy. It's about financial stability. So understand that there's going to have to be a level of consistency to the thing. And that thing may be mastering what it is to be a homeowner and building the accountability. And that could be the people that help you fix your home, your lawn guy, all these things, HOA, make sure that you don't let your house deteriorate. And all of that goes to serve a purpose. So, Lisa, you kind of said a lot in regards to some plays. So I'm going to kind of write down what you said in regards to what home buyers can do. They got a little bit of equity and kind of break that play down again.
Okay, so we go back over it again. Basically, you can actually, if you're looking to access the equity out of your home, you can do a home equity line of credit or a refinance of that home. And when you do a home equity line of credit, and sometimes you may not know what you want to do right then, but if you have a line of credit, you could hold that money there, and then when you get ready to purchase that next home, or you get ready to do something with that, you can actually use whatever funds that you want to use, because if that home equity line of credit is for, I don't know, $100,000, but you may only need $75,000, you can actually access only the $75,000, pay that payment on that $75,000, and you still have $25,000 there available to you to possibly do some work on the home when you get into the home.
So is this you're saying credit, is that like a credit card, or are you giving me $100,000?
A home equity line of credit, it acts like a credit card. So basically, you pay for what you use. And that home equity line of credit is based on the equity that you have in your home. And most of the time, like here in Texas, the max amount that you can access is up to 80% of the value of your home, minus whatever your first mortgage balance is. So basically, if you have a $300,000 home, you only owe $100,000 on your home, but you want to access some equity in your home. And let's just use that you need an additional $100,000, or you think you need an additional $100,000. Well, you can access the additional $100,000 on a home equity line of credit, and from that line of credit, you can use whatever amount that you need. If you need to use $25,000 at a time to do whatever it is that you need to do, you can do it that way, and you're only going to pay the payment on whatever amount that you're using.
Okay, so because I get confused, we're going to make it plain.
Okay.
I know you guys got it. I'm the one that needs help. Okay, so let's just say an example. This is our first home, and it's now worth $300,000.
Okay.
I owe, my mortgage balance is $150,000.
Okay. So that means you have $150,000 worth of equity.
Okay. So how I get the money?
Okay. So first we would say, well, how much do I really have available to me? Because I told you that you have 150, but remember how I said you could only access 80% of whatever the value of your home is minus your mortgage balance. So that amount may not end up being 150, it may end up being $100,000. And the way that you're going to get a home equity loan, you're going to go to your lender, You're going to go to your loan officer, your bank, and you're going to say, I need a home equity loan because, I have the equity in my home and there's some things that I want to do. And so you would actually go complete a loan application, and they're going to do, an appraisal and get your income documents just kind of like you did when you purchased your home. And then they're going to, like I said, do an appraisal, or they do like a value estimate through the desktop underwriting system to determine what the value of your home is and how much they can loan to you. So you do have to go through the loan process. You have to go through a bank, a loan officer, or your lender to access the equity in your home.
So how is this different, I guess, from a refi?
Refinance.
You said the refi is a strategy too.
Because with the refinance, you're refinancing your home. You're refinancing the home, and you are changing the terms of your current mortgage. With the home equity line of credit, you're leaving your current first mortgage in place. So just say if you purchased your home 3 years ago and you have a 3.5% interest rate, you're like, well, okay, I want to leave that in place because I don't want to lose my rate. So then you do a home equity line of credit. A home equity line of credit is based off a variable rate. And so it might be Wall Street prime rate, whatever that is, and that rate, I don't know, could be 4%. And so you're going to say prime rate is 4%, and the lender might have plus a 2% margin. So then you're at 6%. So you're saying, well, if the rate is 6%, I don't want a 6% rate. I want to leave my current mortgage in place. I want to use the home equity line of credit so that I can access these funds, because I may not need the whole $100,000. I may not need the whole $100,000. Again, you may not only need 50 to purchase your next home, or to do renovations on your current home before you sell it, or whatever the case may be. So then you still have that other 50 available to you. On a refinance, you're going to lose your current rate, and then you're going to pay off that first mortgage, and then whatever the interest rate is at the current time, if the interest rate, again, if you have a 3.5% interest rate on that first mortgage, and if you tell your lender that you want to refinance, if the current market rate is 5.5%, you're going to refinance, you're going to pay off that first mortgage that you currently have on your home, and then you're going to get a new mortgage, take the cash out, and that new payment is going to be based off of 5.5%, and then you just get that whatever's remaining after your first mortgage is paid off. Because if your first mortgage is that $150,000, then they're going to pay off the $150,000. They're going to give you the $100,000, and you're going to pay the whole payment based off of now a $250,000 loan.